Welcome to Abley Seminars sessions. Today, we're going to talk about real estate taxes. Similar to government-controlled inheritance zoning, the ownership of real property is subject to certain other government limitations, specifically the right to levy taxes. The costs of government are recurring, and the levying of taxes help to defray these costs. The primary source of tax revenues are income tax, corporate and personal, sales tax, general excise tax, and real property tax. Our interest here will be in the real property taxes. There are many methods of determining property taxes and the values, but the most commonly accepted is the one being what they call the ad valorem, or according to value, tax system. After the determination of an overall state budget, each county will then look at their budget and see how much they need to raise the property taxes and other means of revenue to help run each county government. And the taxes are dictated by the county, not the state. So this amount of tax revenue depends on many things, but really it's how much is the property worth. They're going to look at the assessment for the building and the land. And then, of course, we talked about this in a previous tape, the homeowner's exemption. And at that point, the tax assessment will determine the tax amount for each property that is subject to taxes. In Hawaii, the governor gives each county how much the mayors will get for the next year. Then the county budget committee will then say, okay, we're getting so much from the governor or the state, that how much do we have to raise taxes to make the budget work. And so the counties then go back to the drawing board and look at how much revenues are going to be anticipated by the assessed valuation. Taxes are assessed on a fiscal year, but they're collected in 2 installments, and they run from July 1 to June 30th. The first installment covers the taxes due from July 1 to December 31st, and it's payable on August 20th. Second installment covers the amount due for January 1 to June 30th, payable on February 20th of the same tax year. Taxes become delinquent if they're not paid by each of the installment dates due. And the delinquency is over 3 years, then the counties have the right to foreclose on the property for non-payment of real property taxes. And there'll be an auction made, and the bidder will bid the amount of taxes owed, the back interest, and penalties, and the winning bidder will then take control of the property. Now, the debtor who loses the property will have 1 year right to redeem the property by paying back the taxes, the interest, and the penalty, and the interest accrued during the time the winning bidder held the property. So if the loser or the debtor pays the property back within 1 year of the property auction date, then the debtor has a right to redeem the property. So the right of redemption is limited to 1 year. Each island has different deadlines to appeal what we call the property tax assessment. So if you feel as a taxpayer that your property was too high, then you have to appeal by a certain deadline date, and then you have to talk to the tax assessor assigned to that area and say, hey, I think you're too high, and here's my justifications. And generally, they'll do an appraisal of the property, give it to the assessor, and the assessor will then take a look at the data and say, no, we're right, we're not going to give in. Or they might say, well, here's an adjustment, would you be willing to adjust? And there'll be a negotiation going on between the tax assessor and the taxpayer. Once an agreement is reached, then they'll sign an agreement and they'll lower the tax assessment value. That's typically how it works if you're going to appeal the assessment. Now, the difference has to be at least a 10% differential between what the tax assessment is and what the homeowner thinks it's worth. So if there's less than a 10% differential, then you cannot appeal the assessment. But if it is more than 10%, then you can appeal. So you have to pay the tax first. Then if you win the appeal, then you get a refund. But if you don't win, then you've already paid the tax. So every island has different deadlines. In the event the owner is not able to get the reduction, then he could appeal the case to the courts. And in the case of the court system, if they win, then of course the amount will be reduced. If they lose, then the amount will stay. So it's a long process if you decide that you're going to appeal the assessment amount. And every county, as I said, has different deadlines, and you have to follow the deadline. So if you win the appeal, then when does a change occur? It doesn't happen right away. It happens in the next billing cycle, which means you may have to wait 6 months or a year for your taxes to go down. And I have seen this happen with my clients where they've appealed and they want some reprieve on the valuation, and then it went into effect the following tax period, payment period. So I hope this helps you in understanding what happens in the case of tax assessments, the counties looking at the valuations, and appeal of the tax assessment if you feel that the tax assessment is too high. Hope this helped you. Aloha.